Hi, I'm James, Principal Investigator, which mainly means that I get a guaranteed very short conversation on plane trips. The 40s for fees. So we're looking at the CCCFA, obviously. The fees section are the 40s. Would anybody like to recite section 41 for me? Let's just see how well you know it. No, that's okay, you're forgiven. So in this talk, I want to mainly sort of focus around establishment fees, credit fees, default fees, and prepayment fees, which is the amount payable on the early termination of the contract. Crucially, there's the application to consumer credit contracts. That's important. So no business B2B sort of contracts come under this. And all credit and default fees must be reasonable. That's the essence, that's the core of section 41. So even just to read it out for you, since none of you knew it, a consumer credit contract must not provide for a credit fee or default fee that is unreasonable. So it has that helpful unreasonable word at the end of it, which makes everything a lot, not a lot clearer, to be honest, but we are lucky that we've got other sections that come after that which can help to clarify that. So there are some exclusions. Optional services are one of those. I will come back to that later because it is important that they are genuinely optional as well. So interest is not restricted and fees are. I think this is a really crucial thing to understand when we're looking at the fees provisions, and Anna touched on it earlier. It's about sort of business parity and giving that understanding and that level playing field across industry. So it's there so that they're restricted so that consumers can confidently compare credit offerings, but also that there's a level playing field. So a business charging unreasonable fees can obviously charge a lower interest rate, which means that they have a competitive advantage. So it is very important that they are regulated and watched quite closely. So like any good speaker promoting a concept or ideas, I have a book to promote. I've just realised I printed this out in black and white, which doesn't make it look very attractive, but this is our Consumer Credit Fees Guidelines. It is in colour and available on our website. So I'd really recommend, if you've got further wanting to look into things around this, I'd really recommend looking at it. It really is the manual. It incorporates really helpfully for fees, which is quite a complicated subject, and a subject that you're not going to be necessarily wanting to look at on a regular basis, bringing in together the law, our learnings from Sports Zone in particular, bringing to the Responsible Lending Code, which Crystal alluded to earlier, but the fees part of that. It also brings in some helpful examples as well, so that we're trying to give that extra bit of guidance to help as much as we can. So if we start at the beginning, the crucial part with fees, if you want to charge it, make sure you disclose it so that people know. So you either want to disclose the amount of the fee, or if you can't determine that at the time that people are entering into the contract, the method of how that fee is calculated. So that's a crucial 101. So setting your fees, things you should be thinking about. We've sort of raced along on the slides. We're just going to slow it down a bit now. The first 2 points here, so recovery of costs and also the transaction-specific approach, they are key things that came out of the Sports Zone decision with the Supreme Court. So recovery of costs, to start with that, the law does allow you to recover costs and losses. However, you need to be very, very careful to make sure that you do, there must be an expense that is actually incurred that you are recovering. So to give you an example, if you're working from a home office, and that is an office that you're not invoicing your company for that, there's not an actual expense incurred there. So we wouldn't expect that you'd be trying to recover that cost. We actually prosecuted a lender, cash to you loans recently, for charging a fee when they hadn't incurred the cost. So this is a slightly different twist on it. So they were charging a PPSR fee when they didn't actually register, in some cases, a PPSR registration for that security. So there's the two sides of that, where if you are seeking to recover that cost, you must incur that cost. So a transaction-specific approach, what does that mean? That means there must be a close connection between the cost and the transaction in respect of which the fee is charged. So again, that's really a really key thing as well. So to give you an example of the establishment fee, and I'll come back to establishment fees probably mainly for my examples, but advertising, it's not something that is to do with the Section 42 definition of the steps that you need to be taking, or can be recovering, I should say, when determining the value of an establishment fee. There's also something else that I think I will mention later. I'm just going to skip ahead to just describe the two ways that we see businesses setting fees. So activity-based costing is the first one. So in this is a situation that I sort of see it as a downward look. So this is where businesses will determine their cost per resource per minute. Stay with me. And that includes labour and cost of business costs. So that may be, you've got your direct labour of the person who's involved in establishment activities, and then you've got the costs that incurred with them, their desk, their chair, the portion of the rent, things like that. So if you can determine that cost and then multiply that over the different activities, and I would see in that you'd be identifying specific different activities that the person goes through in establishing that loan, and then multiply that obviously by the minutes per activity. Now when you get that and you multiply those together, you get the cost per successful loan. Now the successful loan is another way of saying a loan that's drawn down. That's just the term that we use in the credit fee guidelines. And that becomes your establishment fee. This way of working is, both the ways of working are good. There's no better way of doing things. But I do want to point out risks, and these are things that we see. So when I point this out, this is problems that we see. The risk that an individual loan approach can risk over-recovery. So I would suggest here that a useful tip is actually to work backwards again to cross-check what you're doing. You still with me? I've got some good-looking faces I'm not seeing drifting off, which is great. So if you multiply that establishment fee by the number of successful loans, that will give you the total cost of all successful loans. So I can give you an example where we've seen this. What happens is that all of this detail is followed brilliantly, but then when you go back again, the cost per minute, per resource per minute is based on somebody working a 37.5 or a 40-hour week. But then when you look at the total cost of all successful loans, suddenly that employee is working 80 or 150 hours a week. So that is the test that needs to be done to make sure that you're not over-recovering. I think one crucial thing with these tests that I'm talking about is just take a step back and look at it, have a wider glance at what you're doing. It's just a sense check to make sure that things fit right. So that's the activity-based costing. The second one is the fully allocated approach. You probably haven't seen that term before. I just made it up earlier with a little help from my friends. So this is where we take the total costs of the business. We subtract costs not related to establishment activities, and then that will give us the total cost relating to the establishment of successful loans. Now, crucial in this is that there needs to be a real assessment of those costs not related to establishment activities. So it may be that we're applying some sort of percentages or the like to, for example, fixed costs. So we're looking at rent. That would be where we'd say, well, look, if we factor in the size of the building, how much of that is attributable to establishment activities, there may be a percentage. So we're talking about the cost line is okay, but not at 100%. Scale it back down again. Now, when you divide the total cost relating to the establishment of successful loans, we get by the number of successful loans, we get the establishment fee. So that's working on this way, I see it. So we're going down the cost lines, and that can be a bit easier if you're a smaller business and looking at your financials. You can just sort of work through and work out whether a cost category is included, excluded, and scale it back as required. But there is another risk with this as well. So we need to exclude the cost of activities associated with unsuccessful loans. That risk doesn't occur in the step-by-step approach, of course, because we're only multiplying it by successful loans. But the danger here is that the value of the establishment fee covers declined or unsuccessful loans, because the costs that you're looking at don't factor that in. So when I talk about that percentage that you're bringing things down, that as I talked about with rent, there also needs to be that consideration with activities involved with loans that aren't successful. You all right? Excellent. So both of those approaches are basically costs divided by number of loans, and we're just looking at it in slightly different ways. So hopefully that's a little bit useful in terms of just working that test to make sure that things are right. The other thing here, forward-looking approach, so realistic estimates based on experience and anticipated future projections. And that was quite long. The crucial part with some of what we're looking at, we've talked about the risks with costs. The number of loans is also a risk. Mainly around declined loans, as we've talked about earlier, but also if we're looking at that denominator, the number that we're dividing by, that has to be an accurate reflection of what's going on in the business. So again, step back. We're talking about fees here that are being set for a future period. So we expect that there's going to be some sort of analysis done by you on hypotheticals potentially, or what you expect to be incurring in the future. If you're looking at the number of loans from the last year, and you're a large growing business, that denominator could be incorrect, and it can be in some cases we've seen quite incorrect, and has a huge effect because of course you're dividing those costs by those number of loans. So it is important to be very careful about that in how you set the number, and also you need to have a clear understanding of how you've set that number as well. Now you may average, but please take care. When you've got an establishment, if I use an establishment fee as an example, you may have different layers. So you may have loans up to 1,000, then loans up to 5,000. Now that may be absolutely fine because there are differing costs that are involved in that. You're going to find that really easy to identify when you're doing a step-by-step analysis, this one, because you'll see, say for example, a manager who comes in that needs to approve a loan that's at a higher amount. So averaging is fine. You can do that to encapsulate to be able to encompass that higher cost within, say for example, differing establishment fees. But just be very careful with that, because we don't want to. We need to see that the cost structure underneath that fee is similar for those different categories of customer. We don't really want to see customers with $1,000 loans, for example, supplementing the cost incurred by a $5,000 approval loan, for example. So now some fees may still be unreasonable. So it doesn't matter how you've done your calculations, they still just may be wrong. So if you've got a pre-possession notice, PPN, and your company policy is to deliver that by helicopter, it's likely that we'll never see that as being reasonable, and that's where reasonable standards of commercial practice will come in. I see nobody arrived in a helicopter here today, so that's good. Nobody to look at too closely there. The other thing also, that cash to you loans example of they may be unreasonable because it's all costed, and that's fine, but you didn't actually do the activity that underlined that fee. I also think it's important that we look at the business model as well. So this comes back to the transaction-specific approach. So your business model, if you're a car dealer and you have got a car sales portion to your business and a finance portion to your business, but you're running that business together, again, step back, have a look at that business model and how you've structured it, because you'll need to be able to carve off the costs associated with the finance side of the business and leave the sales side separately. So we don't want to see you recovering or over-recovering by incorporating other costs that form part of the business. And when I talked about that percentage allocation that you need to look at, that's another area where you want to be able to make sure you're factoring that in. Regularly review your fees. So these are not set and forget. Have your costs changed? There may be situations where you've got a more efficient system that's come into place, or you've got some efficiency gains through different processes that you've put in place. These are trigger events which I think really require you to be able to be looking at your fee structure on a regular basis. Also, as your business growing, I talked about the denominator issue and how that has such a significant effect. So if your business is growing, this is something that you may want to be you need to be looking at again to make sure that your cost justifications are appropriate. Look at the overall picture. Again, this is that step back. You're going to be doing a lot of stepping back, hopefully, when you leave from here today. Your financials can really help in this. So this is almost a good opportunity to have a little bit of a check. If you see in your financials very clearly that your fee income is above the costs that you've incurred in the business, then that is a red flag, and we've seen that. Business is consistent year on year on year where that red flag should be identified because it is staring at as a red flag in the financials, and yet it's just not picked up. So this is another way of testing the fee analysis that you've done, just to step back and say, is this working? Because if it's not, that can cause huge problems. So things we don't like, you'd be interested in this. We don't like percentage-based fees. They really are a red flag to us because when in a transaction-specific approach, which we've learnt about in Sports Zone, they're going to be they're just so unlikely to be reasonable. So 2050 Club was a situation where they charged a 50% marketing koha, 50% of the amount borrowed, and the judge found that to be unreasonable. Even in the situation where we really had to explain why it was unreasonable because the company didn't have any calculation as to how they'd worked it out. So using fees as a mechanism to recover all costs, we have seen this a bit, where somebody takes their line and then apportions 40% to establishment, 20% to a monthly administration fee, and then so on and so on. That's we do expect you to think a little bit harder about these, and fees are not a mechanism to be recovering all costs. Sports Zone again picked up on that and said that that's not appropriate. The failure to consider the bigger picture, that again comes back to when I was talking about have a look at your financials, have a look at those trigger events. So if you're seeing any of those, take that time to really review your fees. Market comparison is the only tool to justify your fees. I'll be very disappointed if I see many more of those. We have seen a few of them. However, I will caveat that. If you are doing it for the reason of seeing what competitors are charging and you want to reduce it to stay competitive, do that by all means. I'm happy with that. And inappropriate averaging is my last one. So this again, if you have differing, if I use the establishment fee as an example, if you've got differing levels of loans, for example, if we had a $1,000 loan right up to $100,000 and you were charging the same establishment fee to everybody, effectively cross-subsidising, so the costs on the $100,000 are being borne by the one on the $1,000, that's inappropriate. We would expect where there are easily identifiable steps that differentiate between customer groups that you should be altering your fees to take that into account. So some tips to help you, sort of from our experience. Keep good records. I know it seems fairly obvious, but this is really, really crucial when it comes to fees. A lot of the time, we expect, as we've said in our guidelines, that you'd be reviewing these at least on an annual basis, but there may be trigger events. What happens, we do see this quite often as well, that when somebody comes to review their fees, the staff member who did it last time has left, or nobody's quite sure what was going on in the head of the person who set them last time. So keep good records. Either write it down or you can spreadsheet it, whichever way you go, so that you can remember what you did and why. I think that is really, really crucial. Now I want to give you an example about why this is so important. So this here, I'm just going to give you a bit of a break because it's quite a heavy topic as well. So this here, I'm currently restoring an old car. And it's taking up my only garage, which my wife loves. But that there is a wiring loom from a 1965 Series 2A Land Rover. If you have any technical questions around that or fees in the questions break, I'm more than happy to field them. That is how I've taken it out of the car, and it's sitting in a big mess like that. If I don't label where every single wire goes, in the 2 years after I've done everything else and want to come and put it back again, I'll have no clue as to where it goes. And I think that's the same thing with fees. So I have labelled everything. And you come up with a beautiful, in my mind, diagram which will be extremely useful in 2 years' time when I need to put it back together. just bearing in mind that that looks complicated, but this car does not have reversing sensors, air conditioning, GPS, electric windows. It doesn't have any windows at the moment. So you can imagine how complicated your car would be. So I like this example, and I would encourage you to review your fees every time you see a vintage Land Rover. Maybe that's quite a good little test to take away as well. But keep your records there so that you know what you're going to do when you come back to review them, so you don't have that. So evidence-based decisions, where you're making decisions and using assumptions, just document why you're doing it. So if 50% of James's salary is used going towards establishing activities, why? Why is that? Record that, write that down. Clear and supported evidence of costs. So this is proof of how you've determined figures. So it may be appropriate that you use different figures to what you've got in your financials. If I give the example of a company who's moved into a bigger premises, it may be inappropriate setting fees going forward that you use your last 12 months worth of rent. It may be appropriate that if you've moved in the last 3 months, you know that that's what your rent level is going to be. So I'll extrapolate that 3 months to 12 months. But somebody coming into it isn't necessarily going to understand that. So just write that down, document it so that people know. Don't hard code numbers. This is mainly if you're using spreadsheets, it's so much easier if you can leave a formula flow going through it. Spreadsheet people understand exactly what I'm talking about, and that can go a long way to understanding exactly what's going on, even if there is a little bit of confusion as to how people have worded it. And calculating estimates, I think this is crucial when it comes to estimating your future, say for example for your establishment fee or even your default fees, your estimates of how many that you are going to be charging in the next 12 months. A really sound reasoning is required to be able to determine what that denominator is going to be when you're determining what to divide by. And fee simplicity, I think that comes back to my wiring diagram picture. Do yourself a favour and don't have 5,000 fees, because when you come back to review them, it's going to be an absolute nightmare. So to keep things simple is good for you and also your customer. It's easy to understand for you and your customer. So if I move on to disclosure quickly. So disclosure, when you're disclosing to consumers, it's just vitally important that they understand what they're getting into. Disclosure is required at different times for different reasons. So standing disclosure, we've talked about some website reviews that we've done for online disclosure for cost of borrowing, interest rates, fees, and also standard contract terms if they're appropriate. So that's required. Initial disclosure, of course, that's required before the loan is signed, crucially. Before the 2015 changes, that was different, so of course that's a change. And just going back to the standing disclosure, the premises, if you've got a premises that you operate out of, it is important that you have a notice displayed showing that the customer can ask for that disclosure, and you need to be in a position to be able to provide that. Continuing disclosure, that has been a change under 2015 changes as well, so you must provide a statement every 6 months showing payments and charges, and revolving credits, it's 45 days. So variation disclosure, we've had a few interesting investigations around variation disclosure recently. So the full particulars of the change are to be disclosed to the borrower. So we as the Commission expect that those changes would not only be the change that has been agreed, but also the flow-on effects. So for example, you're agreeing a variation to extend the term of the loan. We would expect that not only the payments would be provided for in terms of the change of those payments, but then also the flow-on effect to, say, interest and total payments, for example. Some common problems with disclosure. I'm going to read this out. This is from a live truck shop prosecution that we had. 1, contractor purchased. The customer agrees to purchase the goods described on the face page of this agreement and to pay James McIvor Trading as James, for the goods by the direct debit, DD, or automatic payment instead of cash picking, according to the repayment schedule contained, which is not a banking day, being a day on which registered banks are open for business in Auckland or any other city or area in which the customer resides. The DD and AP authority forms signed by the customer shall provide accordingly. I don't want to see any contracts like that. That is just hideous. So yeah, as I say, we've seen that. I think there's a lot to be said for just keeping your disclosure simple, so that customers can understand what's going on, so that you can understand what's going on. The trouble is, later on, you may not even, nobody understands it. It's hopeless. So confusing and unclear disclosure. It's a document for your customer. I appreciate that there are things that you want to get out of it, but just remember who's actually reading it as well. So a couple of things that we see with disclosure in terms of problems. We're still seeing a few of the 2015 changes missing, and I think Anna alluded to that point earlier. So hardship information, disputes resolution, service information, and cancellation timeframes seem to be the three favourites. Confusing disclosure can be a real problem as well. So that's a section 32 that we look at it under that. And of course there are responsible lending obligations to assist your customer to reach an informed decision. That comes back to what Krista was talking about, understandability. You have an obligation to make sure that it's clear. Those sorts of terms and long, confusing contracts that are laid out poorly aren't doing it.